Here we go. And we're back. All right, here we go. So I think we're in good shape now. So just a little bit about me. I've been in this space for 26 plus years, doing financial services, and specializing primarily in life insurance and retirement planning, and those type of things. And I do have a book. It's called Increase, Protect, and Dominate Your Money. And that was released in February of 2022. And so I'm very proud of that work, and really kind of talk about how we can utilize life insurance and annuities and some of these types of things to kind of, just put us in a great position financially in terms of supplementing our retirement income or education, and being able to do it where we're not at risk of market losses, as well as some real tax advantages there. And so I will put the link in before we're done in terms of how you can get the book. And so we'll have that there as well. So what really sparked this and kind of gave me this thought to do a webinar called, GoFundMe Not Life Insurance, is when I saw this video on TMC. Many of you may be familiar with the movie series Friday, and one of the stars there, one of the comedians, was Anthony Johnson, and he passed. And this is a video of his wife as she went on TMC to make a plea. And so I'm going to play that and then kind of open it up for some questions or thoughts or reactions. Let me do this because the volume on it's pretty low. I'm going to reshare and hook up the sound to it. All right, here we go.
I did the GoFundMe. There's $700 in there. Few of my friends cash at me, and I made that clear. I got like another 400. But no, it's like you say, y'all say y'all love him. Where's the love? Y'all not helping. Like, I get the calls or inboxes saying y'all raising money. You trying to, no, we're raising money because I have to pay for this all out of pocket. I'm asking for help, but if I don't get it, it's fine, because I'm not leaving my husband in there like that. You know what I mean? We're gonna have a service. I'm gonna do everything I know he would have done for me. It's just hurtful, like, I would not be asking if we had it or we had a policy. Do you know what I mean? Like, I'm not the one, it's people that's saying that they're gonna give money. We haven't received it. If I just look at it right now, it's all out of pocket. Just to bury him in the funeral services alone would be close to 15. I asked for 20. I mean, I would give the kids, split it among the kids, it's 4. But if it's nothing left, it's fine. I want to put him in Rose Hills, but if we don't have the money to do that, we will have the service and I will cremate him. If you guys want to give what they want to give, I would appreciate it. If they don't, that's them. But just please stop the fake love. Please stop the fake calls. Please stop the fake texts. Please. That just for our family. And when I say our family, I mean me, the kids, and the grandkids. Just stop it. Just stop. I'm gonna stay busy and I'm going to work. I'm gonna work in a couple days. So I'm not gonna worry about this. I apologize. I'm not gonna worry about this. Whatever happens, happens. It's God's will. But I'm gonna go to work in a couple days. If I had the strength, I would go right now. I don't have the strength. It took everything in me to get on here and do this. I'm gonna be all right. We're gonna be okay.
So let me pause here and just get some reactions from you all. When you see that video, and her, well, you may have different opinions about her ask or her plea, if you will. But share with me a little bit about what your thoughts are when you see that. Has anyone experienced it within their own family? I mean, tell me a little bit about what you think when you see that.
I can say something.
Yes.
Hey, everyone. I can relate to that emotion, that feeling, because I have a brother who passed away when he was 39, and our parents moved out of state. So it was only me and him in the same state. And when he passed away at 39, he was it was like a hit and run situation. So we didn't know like that was going to happen. He wasn't prepared. And I was the first point of contact. So I was so scared and I was like, oh my gosh, how are we going to do this? And it was around like income tax time. So I thought I was going to have to use my little bit of income tax. I have 2 children. I thought I had to bury my brother with the little bit that I have. But he was such a great man that friends and family just came. I didn't even have to do a GoFundMe. Like people just was pouring into us, giving us money. People for little kids, $500 here, $1,000 here. So we were able to bury him. And after that, I was like, I never want to experience that again. So I ran and I got life insurance for myself and my children.
Awesome. Thank you for sharing.
So I can that feeling.
Yeah. I know there's a lot of people who've been through it. And you know, back in my day when I was growing up, it was always, you know, the car washes or the fish fry or whatever to raise money when someone passed that didn't have it. But you know, what a blessing that you had a community around you that came and supported what you're doing. So that's awesome. Anyone else? Anyone else? Any thoughts or emotions that come up when you see that video? No? All right. We'll get back to the PowerPoint. So, one of the things that I don't know if people realize how many of these GoFundMes are started every year to cover funeral expenses. And again, when I saw that video, it just made me say, wow, you know, I knew it would be a lot. And I started doing some research. And I don't know if anyone has any idea, probably some of you do because you've seen this before, heard me say it before. But there are over 125,000 GoFundMe started every year to cover funeral expenses. And then when you think about that, 125 per year, and what do we have? 350 days, 352 days a year. I mean, that turns out to be a whole lot per day. And oftentimes we don't, you know, people have been critical of this whole GoFundMe thing, but it's not the families that are left behind that are really the ones. They're victims too, right? They're grieving plus having to figure out how to do this. And you know, there are instances where you have a George Floyd and some other things like that happen where people give and they raise more money, and then maybe there's some really good that can come out of that. But that's a lot, and we need to plan for it, because one thing that we do know is that at some point, and who knows when, but at some point we are going to pass on, and there's going to be a bill that is created when that happens. And here's the thing. This is an alarming study done by New York Times. New York Times said in the African American community, African Americans are 10 times more likely, listen to that, to a factor of 10 times more likely to own insurance on their cell phones than they are to own life insurance on themselves or your children or their children. 10 times more likely. And so are we really saying, are we really believing that these little phones are more important, more valuable than our life. And that's an alarming statistic to me. And, I think that it is a mindset that we need to really address in terms of making sure that we're prepared. In my 26 years of doing this, folks, I've heard all kinds of excuses of why people don't get life insurance, right? I mean, I've heard everything from I don't want to jinx myself to whatever. But we really got to change that mindset. And that's what I hope tonight is, that we can be a disruptor of the mindset and also be educational tonight. And maybe there's someone in your family, maybe it's not you that needs this information, but maybe it's someone in your families, maybe someone who's going to get this recording that you share it with, that is going to make a difference. And in fact, on my live show on Tuesday, we have a gentleman that will come and share a story of his brother, and that was just that same type of situation. So, life insurance. This is the very reason we don't want to talk about it, right? Because we think of it in terms of death. But it's one of the things that we have to be prepared for, because we all are going to pass. And, what if we started treating people the way they plan for it, right? What if that were the case? So if we have life insurance, average funeral is what? Average funeral is somewhere between $12,000 and $15,000 on average. And there's so much of that it used to be handled by the funeral home, and then they wait for the life insurance. But so much of that now you have to pay upfront, right? For the cemetery plot, the vaults, a lot of different things that have to be paid for upfront. And I've seen situations where families will get mad at a funeral home because they won't bury their loved one until it's paid. But from the funeral home standpoint, they're not a ministry most of the times. They're not a charity. And if they put all that money out there and then never get paid, then it's nothing they can do. So I can understand it from a business standpoint. So this is the average cost. And so if you don't have, I saw this years ago, and I said, wow, there is a casket at a resale shop. This was in a rural area of North Carolina. It's like, man, that just seems to me like, that ain't how we want to go, right? Those aren't the choices we want to make. And so we want to make sure that we're properly protected, so that our families don't have to make tough decisions in terms of how they're going to even put us away. And as we go through the presentation tonight, we're going to talk about not just the cost of the funeral, but what about living after the funeral? And so because of the cost of funerals, we've often turned to cremation. And and I started doing a little research, and it's like, well, how does this cremation work? What really happens? And this is what I found, is that they burn off the water, the soft tissue, the organs, all these things, and then the bones are left, and they put those through a processing machine. And so you end up with this, that's when you end up with the ashes. And it's not a pretty thing, but a lot of people turn to that. And even now, the cost with cremation and a viewing. So if you have a viewing and then the cremation, according to US Today, the average cost of that, the median cost of that is $6,900. And it's increasing at a rate of about 11% per year on average. So even the cost of cremation is going up. Now, kind of turning the tide a little bit. This right here is a scene from the Black Panther movie. This is my favorite scene, one of my favorite scenes of the movie. And when he goes and he visits the ancestors, and his dad tells the child this, he says, "A man that has not prepared his children for his own death has failed as a father." Obviously there's a lot to that, right? Because I think preparing our family for our death is more than just buying life insurance. It's a big part of it because our children, our family, our spouses are going to have to survive after we're gone, right? But there's a lot more to it in terms of wisdom and instilling work ethic and all these things spiritually that we sow into our children. But this very simple financial step that we should be taking is really simple, and it really does show our family and our loved ones that we love them. It's that last gift that we give. So my favorite scene of the movie, and I just want more of us to be prepared for when that happens. And I'm praying that we all live a long, prosperous life. But the reality is that, death occurs sometimes unexpectedly. So let's get into a little bit in terms of what we should be doing, reasons why we should have life insurance. And one of those major reasons, as we're talking about, is to provide financial safety for our family and loved ones in the event of our passing, so that we can help cover the living expenses, pay off the debt, maintain their quality of life. That right there is the number one reason that we buy life insurance. It's a love letter. And so that's one of the reasons why. And then what about debt? Right now I'm teaching a class called Debt Elimination. And, we don't want to leave debt. So life insurance could be used to pay off outstanding debt, help cover the mortgage, car loans, credit card balances, all those type of things, so that our families are not inheriting our debt. So we're not doing that. And I always talk about, Papa was a Rolling Stone. Where he laid his hat was his home. And when he died, all he left us was a loan. We want to change that narrative. We want to leave assets. We talk about generational wealth. We want to leave generational wealth. Life insurance is one of those ways that we can do that. And then income replacement. And again, if you're the primary breadwinner or a breadwinner, period, life insurance can be used to replace your income, to meet those daily expenses, including the bills, groceries, educational costs, any of those type of things. Anyone have anything else? Any other reason that you could think of for why one should have life insurance?
To help out in case of illnesses.
Yeah, absolutely. And we'll talk a little bit about that, Timothy, in terms of life insurance today is more than just about the death benefit. 100%. And then the other thing could be, medical bills. Like if we suffered an illness or we have something and we have medical bills that have to be taken care of. We talked about funeral expenses, final expenses. Again, the average funeral being between 12 and 15,000. Estate planning, in terms of if we have a estate that ends up having probate costs or estate taxes and those type of things, it can help to make sure that those funds get passed on to our children the way we intended to, and they don't have to use those assets that maybe we have left and prepared for to pay the taxes. And a lot of people say, well, the estate exemption is so high, it's around $11 million or so, but there's a couple things that are excluded outside of that. So for example, if you have a 401k or a 403b or retirement plan that you leave to, especially if it's not a spouse, there's taxes that have to be paid on that money. They have to report it as taxes. There's no exclusion for that. And so if you saved up, couple 100,000 in your 401k and you pass and it goes on to your children, they're going to pay taxes on it. Life insurance can help cover those taxes so that what you've saved in for your whole life gets really passed on to those who you want to receive it. And then in a business environment, business continuation, we buy-sell agreement. So if you have two people that are in business together and one of them pass, what happens is then whoever is the beneficiary, next to kin, or however that looks with the other business partner now becomes part of the business. And for many business owners, they would prefer that not to be the case for whatever reason. And so business continuation would be using life insurance as a buy-sell agreement, that if one of the partners dies, there's life insurance on that partner so that they are able to buy out the other's family so that they then have 100% ownership of the business. The other thing is key employees. Sometimes businesses take policies out on their key employees so that if something happens to them, that they're valuable to the business. And so generally speaking, when you have those type of situations, it might be the business and a spouse who is the beneficiary of that policy that is then paid for by the company. And then the other thing again is legacy and charitable giving. And again, it's one of those things that we often talk about, generational wealth, but what are we doing to create it? And life insurance, again, allows us to leave a financial legacy for our beneficiaries. Maybe it's making charitable donations. It could be to your church, could be to a nonprofit. It could be establishing a trust for your family. It could be establishing a family trust. These are all things that life insurance can do in terms of the reasons why we should have it. Now, this is always a great topic. It's people's feelings about term insurance versus whole life run deep. And so let me stop sharing for just a second and see if anyone has any strong feelings one way or the other about term versus whole life. So anyone that feels like term is the way to go. You can come off of mute.
I think term is for like what it says, like a term. So if you have children and, your children are in, school and stuff, and while they're dependents, like you would get term just in case, anything was to happen to you, they can still live and, do some of the things that you possibly would support them with, like going to college and stuff like that. So, making sure there's enough money there so they can live and operate continuously the way you would support them. And then once they get older and they're independent, you possibly could decrease that. But I do believe in whole life because I like the fact that the whole life has the cash value that's growing and growing and growing and growing. So.
Absolutely.
I was going to say that. I was going to say if funds are very limited for single parents or parents, income protection, like she said, I think if that's all you can afford, it's definitely better than nothing. And if something happens, you can make sure your house is paid off, your kids are protected, and they make it through college.
100%, Audrey. Thank you. Yep. I agree with both of you. Anyone else? The question that came up in the chat is, for younger people, what is better? Is it term or is it whole life? And, I really think the answer to that really depends, right? It depends on affordability because there are certain advantages, certainly, for buying permanent life insurance when you're younger, because you're locking in the younger age and all those type of things. And simply the time value of money makes sense in many cases. So I think it can go either way. Absolutely. All right, let's return it here and see what I said about it. All right, so let's take a look. When we talk about term insurance, as we've been talking about, it lasts for a specific time and date. So it's really designed for temporary needs. It is the least costly. The analogy that I use, it's like renting. It's like renting an apartment, renting a home. When you rent, long as you pay the rent, you're covered. You can live there. Same thing with the term. When you leave your apartment, you're not really getting anything back. Maybe your security deposit at the most, right? And they'll try to find some ways to nickel and dime that out of you as well. So that's kind of how I equate to term. And then on permanent insurance, and really we should be saying permanent insurance. We generalize and say whole life, but there are a couple different types of permanent insurance. They all are designed to last your entire life. What we deem your entire life in today's instance is 120 years old. They gain cash value. It is an asset. You own it like you own your home. And when I say it's an asset, it's like even if you were filling out an application for a job or something and you had to list your assets, oftentimes they ask you about your life insurance, right? The cash value of your life insurance. So it is considered a Class A asset. And again, it's like owning your home. As time goes, you build equity. You can do different things with that equity. You can use it for retirement. You can use it for vacation. You can use it to pay bills off. You can use it for supplementing your retirement. And so as we were talking about it, and Shanta and Audrey were spot on in their comments as it relates to it. Here's the thing that I always say is that the best policy is the one that's enforced when you die. And that kind of leads a little bit towards what Audrey's saying is like, if you can't afford a permanent policy, then to have a term policy is fine. There's no harm in that. And anytime someone tells you this, is that you should always buy term or you should always buy permanent. Those are a couple things that I think would always send red flags up for me, because it really depends on your situation, depends on why you're buying it. Maybe it is to cover just your mortgage, so you don't need it on a permanent basis. Maybe, it's just what you can afford at the time because you just bought a house, or your family is expanding and you don't know how expensive those things are going to be. So there's different reasons that you might want either one. And I will tell you this, I think if you're going to get term, that you want to make sure you get a convertible term, one that can be converted into a whole life, and all of it or in part, so that when that permanent need comes up and you realize, hey, I am going to need some life insurance for all the reasons we've been talking about, that even regardless of your health or occupation, you can make that change. So I think that's important. When we start talking about whole life, I think I saw something pop up in the chat. Let me make sure I address it. All right. So when we're talking about whole life is probably the more structured permanent insurance in terms of you got a guaranteed death benefit, the premium, minimum, cash value, accumulation rate, these type of things. And so it has less flexibility than our other type of permanent insurance. So whole life is something, it's been around. And honestly, all policies are really based on term life rates, except for what you do with the whole life is you take all those rates, you add them all together and you divide them by the number of years, and you get a rate so that you're paying a standard amount from the beginning versus it going up in time over time. Universal life is more of a flexible premium and also can be a flexible death benefit, meaning with a universal life, you can increase your premiums, you can decrease your premium. Same thing with the death benefit. And within the universal life, there's 3 types. You have your standard type of universal life, where it's just based on an interest rate that is determined by the insurance company. That might be 3%, 4%, whatever it may be, but that interest rate is determined by the company. And then you have the variable. Variable universal life is strictly stock market driven. We call them separate accounts when they're within a life insurance plan, and they work exactly like mutual funds, right? So when the market goes up, the values of them go up. When the market goes down, the values can go down. It was very popular in the early 90s, late 80s, when the stock market was just booming and all that type of stuff. But when we went through some stock market crashes, they lost some of their popularity because people were losing a lot of their cash value because of the stock market declines. So index, which is actually, if I were to pick one and said what one I would think is better, I like the index. And it's actually index universal life in the last 10 years has been the fastest growing life insurance product available. And how the index works, it's based on an index such as the S&P 500, or maybe there's a lot of different types of indexes. But how that works is when that index goes up, your cash value grows up. When the index goes down, you don't lose any. So you're either going to stay where you're at in terms of market fluctuation. You're going to either stay where you're at, or you're going to go up according to that index. And that concept is very important. The other thing that you can do with universal life, particular index, is you can turn it into lifetime income. You can turn your life policy could turn into a pension. And we're going to do another one of these webinars sometime in October, where we're just going to be talking about creating lifetime income. This is one of the tools that can be used for that. And really, there's 2 or 3 types. The 2 most popular types of death benefit is a level death benefit, and then also the other is an increasing. How a level death benefit works is that if you have $100,000 policy, it's going to stay $100,000. Your cash value is going to build up inside of that $100,000 death benefit. Increasing death benefit, what happens is your death benefit starts at $100,000, but as your cash value grows, your death benefit goes up accordingly. So if you have $5,000 of cash value, then your death benefit is going to be $105,000. And so those are the 2 different ways to structure it. And then the third level is where it starts going up, and then at some point it levels off. Some places have that; they call it the C. But most people are doing, level A. The reason why I like level A in many cases is because your cash value grows faster in a level A than it does in a B. But again, that's really individual situations to kind of determine which is better there. So any questions about that, or any thoughts? Anything new there? We good? All right. Well, let's continue on. The question always comes up is, how much life insurance should I have? And some of this kind of reflects back to some of the reasons we buy it. Okay, we did have a question. For an IUL, how do you get benefits early? Well, the great news with the IUL and permanent life insurance, particularly IUL, is that as that cash value grows in there, you can actually borrow that out as a loan. So you can do a policy loan, borrow the money out, and use it for whatever you want. And depending on if your policy, how it's structured and those type of things, though, you may or may not have to pay that money back. Now, the other thing I tell people is, when you're looking at life insurance in terms of cash accumulation, and we know we see all kinds of things on the social media, be your own banker, family bank, and all those things are true, but it's all relative to how much money you're putting in there. And so the more you put in there, the more you'll have for those things. But it's not like you can't get blood out of a turnip, as they say. So when I tell people, and most people are putting it in at a pace that really will allow them to, 5-10 years, be able to start to maybe pull some money out and use it if they want. But obviously, the longer we wait, let it grow, the more we'll have. But the important thing is that there's no taxes, even if you're taking it out before 59 and a half and some of these types of things. So when it comes to how much life insurance, I use the acronym LIFE. I think it's just an easy, simple way to think about it. Of course, we have all kinds of calculators for determining that. But, very simply, the L is for loans and debt. How much will you need to pay off your debt? Your mortgages, your student loans, your automobile loans, credit card debt. Now, if those things are just in your name, they may not be necessarily something you're too concerned with, but they can go back against your estate and get some things. But you just want to know, just know that dollar figure, how much to pay off the mortgage, to pay off the cars, etc. And then the income replacement, right? So how much of your annual income will your spouse or your family need if you were to die today? And how long would they need it? And generally speaking, it used to be most companies would offer you, as far as a benefit at work, 1 to 2 times your income. Well, when you think about it, if they offer you 1 or 2 times your income and you have a 2-year-old, you have a spouse and a 2-year-old at home, what are they going to do after the 2 years? And so generally speaking, as a rule, usually 7 to 10 times your income is good. I usually say take 2 times your income and then add for each dependent. And so if you have 3 kids, then you can use 5 times your income as an income replacement. And then the final expenses, again, we've been talking about the cost of a funeral. We've been talking about other expenses that you would need in terms of death taxes on your retirement accounts, maybe attorney court fees, those type of things, to transfer property and other financial assets. So that's the F. And then the E is for the extra things that you might want. You may want to set up an emergency fund for your family. You may want to establish a educational fund for your children or your grandchildren. Maybe you want to create a family legacy or trust, those type of things. And so these are all the components. When we put a dollar figure on all these, we add them up, and that's an estimate of our life insurance needs. Now we can then subtract out of that life insurance that you currently have, or maybe savings that you have set aside, those types of things. You can, subtract out of that and have that final number of what your need is. So again, I encourage, if anyone has a question or comment or thought, please feel free to go ahead and unmute or, put it in the chat, and I'll try to catch it there as well. Now, here's the thing. Old insurance versus new insurance. I tell this story that when I was a teenager, I wanted a car, right? I wanted a car bad. And so I told my dad, like, hey, Dad, if you bought me a car, you wouldn't have to take me to football practice. You wouldn't have to take me to the little job I had. I drive myself to school. You would save a lot of running around, right, Timmy? And so what my dad did, my dad went out and found a deuce and a quarter, Electra 225. And, this was in the late 80s, right? Or mid 80s. And it was a 70 something. And what I told my dad was, I don't want that old folks car. I don't want that, right? I wanted a new car with a backup camera and a screen and all the bells and whistles that we think about cars now. And that's how I look at the old insurance versus new insurance. Is there anything wrong with the old insurance that we had for a number of years? Classic, right? If I could go back, I'd get that deuce and a quarter. I'd keep it. I'd keep it up. I'd have it today. It would be a gem, right? But then we have new cars that have all the bells and whistles. And I use this analogy to say that a lot of people have the old insurance versus the new insurance that doesn't contain some of the things that policies have now. And sometimes it makes sense to replace them. Sometimes it doesn't. It really depends on each situation. That's why I encourage you to set up a free consultation. We'll talk about that. New insurance, many of them, and even the old insurance, many of them cover, terminal illness, but they had a very short window. So your terminal illness had to result in a death within 6 months or something like that. New policies now expand that to 24 months. So if a doctor says you have life expectancy in 24 months, you got benefits you can use. Chronic illness is another benefit that we call these living benefits. And that includes things like when you need help performing the daily activities of living, like eating, dressing, bathing, toileting, etc. Nursing home care is what we think of. And then we have critical illness, cancer, heart attack, stroke, and I'll go over some of these examples with you here shortly. And then there's also critical injury. And in most cases, there's a lot of different ones out there. They're not all the same in terms of living benefits. And a lot of companies do charge for those extra benefits, but most of the companies that I deal with do not charge you any extra premium to have those type of benefits on your life insurance policy. And so we affectionately call it life insurance you don't have to die to use, because we could go through a medical crisis, we could go through a serious medical situation that we might need cash flow to help maintain our standard of living, or maybe it's to get alternative medical treatment. Could be a number of different things. And so it's good to have the new type of insurance for that reason. And then again, we've been talking about cash value, money that you can borrow. Typically, it's tax-free money. It can be used to supplement your retirement and those type of things. And then as we were talking about the chronic illness, and I'm going to show you guys an example of a quote that has those things on it. Again, when you're unable to perform 2 of the daily activities living, or you have a cognitive impairment. And then again, the critical illness, things like aorta surgery, being anemic, blindness, cancer, cystic fibrosis, kidney failure, and so forth. And again, I will go over these in a little bit more detail on the example of the quote that I'll share. There goes a little one. There goes a reason. There goes a why, right? Absolutely. Hi, sweetie. Look, she's waving too. She's outgoing. All right. So just kind of, the other thing I wanted to just mention is we have this other thing out there that's really kind of unique, and it's called a Kaizen. And what a Kaizen does, it is really a strategy where now your premium dollars that you put into a life insurance contract is matched by a lending institution, right? So you put in for 5 years, they match you for 5 years. And then the amazing thing is then years 6 through 10 in this particular case, you do not have to put any funds in yourself. And so basically this turns out to be a 3-to-1 match. And it's not designed for everyone, but for those who really want to get into it, it really can be a great supplement to your retirement. And the example that I used I believe I used a 40-year-old male, again, I believe it was 40-year-old male, that puts in over 5 years, $151,000. So over 5 years, they put in that amount. And then the bank, the lending institution, is matching that with 400 or 399,000, basically 400,000. So that's your 3-to-1 match. The amazing thing is, what do you get on the back end of all of this? Well, first of all, you're going to get a death benefit of about $1 million. Excuse me. right from the jump. So you're going to get $1 million of death benefit, much larger death benefit if it was just your money in this particular case. And then in this example, at the age of 65, this individual would then be receiving $83,000 per year of tax-free income projected out for, in this particular case, 90 years or 25 years to age 90, which we're just using IRS mortality tables for that age 90. But so it is a real significant, when you think about it, you know, for an investment of 151,000 and to get $83,000 a year tax-free out on the back end at retirement is pretty amazing. And then when we look at it from a cumulative standpoint, over those 25 years, this individual would get out about $2.1 million of income over those 25 years for that investment of 151,000. And even at that point of being 90 years old, there would still be over a $600,000 death benefit that would be left to their family. And so this is a great plan to create wealth and retirement for yourself, as well as leaving generational wealth. And so wanted to share a little bit about that. And I love this quote from Eugene Mitchell. He wrote the book called Closing the Racial Wealth Gap. Great guy. And I love this quote that he made when he was on my show. He said, I know Black Lives Matter, but how much is a Black life worth? How much is it worth? How much is our life worth? And one of the stories he shared on my show about that is when he was actually working for New York Life. And as he became a top executive, the company put a $2 million life insurance policy on him. So if they valued him at that, he's had to think about it. Well, if I'm worth $2 million to them, what am I worth to my family? What should I be worth? And so just thinking about that. And then ultimately, life insurance is really not about us, right? It's about those that we love, those that we say we care about. This is happened to be a picture of my family. My son got married, not this last August, but the August before. But that's why we do it. We do it for those people in the picture. We don't do it for ourselves. Ultimately, that's why we do it. Now, fortunately, we have products, we have different things that do benefit us, right? That we didn't have back years ago. We didn't know those things existed, and they've been around forever. And so, but that's why we do it. We do it because we love someone, and it's a great way for us to build some assets and stuff for ourselves. So that is the last slide. Right there, you do see a QR code that if you wanted to scan that, it will take you to my electronic business card where you can see and schedule appointment to have a free consultation with me where we can review what you have, make sure that you have what you need. And sometimes it's a matter of me saying, well, you know, you need to keep this, but you need to tweak it here, tweak it there, all those types of things. So I am going to, again, stop sharing right here and open it up for some questions that anyone might have, or thoughts, or any comments before we look at a couple of examples. No
Hi,
one?
Tony. This is Noreen. Can you
Hey,
hear me?
Noreen, how you doing?
Good, good. I just wanted to thank you. This was very informative. I've been waiting for this one.
Ah, good, good.
We'll talk soon.
All right, looking forward to it. I'm going to be sending you an email tomorrow with some information
Okay, thank you.
to share with the team. Anyone else? Any other thoughts in terms of, was this educational? Was it, did you pick up anything from it, or it's all stuff you've seen and known before? All right. Okay. Let me do this. I did want to just share with you real quick a couple examples of what this could look like. And so what I did, I made up a fictitious person, right? And this fictitious person is named Leanna Brown. I'm sure that there might be someone in the world named Leanna Brown, but if it is, I don't know her. And so this was just, I didn't want to pick a real young person. I wanted to kind of go mid-age just to give an example. And so I think I made her 45 years old. And this is actually a term policy, right? So for a term policy, again, it's for $250,000. You can see that it's relatively inexpensive, $44 a month. This is a guaranteed rate for 20 years. And it is convertible. And so again, with this particular plan, it is convertible up to 15 years. And so what that means is that if they wanted to convert it into permanent life insurance, they could do that within the first 15 years. They don't have to worry about their health. They don't have to worry about height, weight, medicine. They have medical challenges, or even if they have a dangerous career, you don't have to worry about any of those underwriting things that we initially look at when someone takes driving record, all that stuff. You don't have to look at that. And then even for many people who like the Kaizen idea, they like that, but they can't afford it, they can simply do $1 million term policy and then convert it to a Kaizen when they're ready. And so it is convertible. And I do think that's important, is to have that convertible, because I've ran into so many times where people will have a policy, they'll have it, and then the term runs out, and now they have to get another policy, but something's going on with their health. Now, this particular company, and most of the ones I deal with, not all of them, but most of them, when it comes to the term policy, they also offer those living benefits that we were talking about. The chronic illness, the critical illness, critical injury, Alzheimer's disease. So that is also the case here. And in fact, let me skip down a little ways and just show you those benefits in here. Let's see, we got, all right. And we go down here. All right, so again, we have the terminal illness here, and we have chronic illness there, 24 months for the terminal illness. Chronic illness, again, when you need help doing, when you are unable to perform without assistance, the activities of daily living, which include bathing, continence, dressing, eating, toiletry, and transferring. And again, there's no premium for these things. Critical illness, as we talked about, again, aortic graft surgery, anemia, blindness, cancer, cystic fibrosis, ALS, kidney failure, heart attack, heart valve replacement, major organ transplant, motor neuron disease, stroke, and cardiac arrest. All of those are there. And then critical injury would include coma, paralysis, severe burns, traumatic brain injury. Okay. So all those are there. And so those are those living benefits we talked about. Now, one of the things that happens oftentimes when people if they get into a term policy, they don't remember that at some point that term policy is going to go up in cost. Most term policies don't necessarily end. Ideally, I like 20-year term policies the best. And part of the reason, my feelings for that, is that 10 years can go by awfully fast, right? And then when you get into a 30-year, that's a long time. You might as well really be looking at a permanent plan if you're going to spend the cost to get a 30-year. So I prefer 20-year. And as you can see in this case, the annual premium is $528 a year for 20 years. So over that 20 years, you'll spend $10,000 on the plan, and the only way it's going to pay is if you have one of those critical illness, chronic illnesses, or you die. What happens in the 21st year, the policy doesn't cancel on you, but as you can see, it jumps to $4,500 per year. And so when we're looking at that from my handy dandy calculator here, 4,575, you are now paying for that term policy. You're now paying $381. By the time you get, and I'll just use the bottom line here, by the time you get 72 years old, you're paying now $8,991 for this term policy. And that is over nearly $750 a month. And then it just continues on. So now, if you've been in that policy for 30 years, you've now paid $83,000 for that policy. And it's just going to continue to go up. Okay. By the time you're 84, you're into 40 years, over 300,000. And so in essence, for most people, the 20 years, they're either going to have converted it or they're going to cancel it. Most people aren't going to normally keep that policy going unless they have some type of medical situation that will not allow them to get coverage anywhere else. So that's just kind of how term works. Any questions, thoughts? Okay. So now when we go to a permanent plan, in which I'm going to show you an index universal life plan. Again, this is designed to give you cash value and all the other things we talked about. So in this particular case, $300 a month gives you $250,000 worth of coverage. Now, what's nice about it being a universal life is that if you need it, let's just say something happened and you needed to take a couple months and reduce that down, or go to $1 a month or $25 a month for a while or whatever. Like when COVID happened, I had clients that needed to do that, right? Because they were out of work. The company was shut down and now they couldn't afford the 300 or whatever they were doing. And so we have the flexibility to do that. Now, so for $300 a month for the same person, same age, getting to $250,000. But now our cash value is growing. So by the time they hit age 69, they have over $100,000 in there. By the time they hit 79, they got $209,000. And again, we have all of these same benefits here in terms of the terminal illness, chronic illness, critical illness, and so forth. Now, these are higher amounts than what you have in the term, but they still are, but they're there. And the only other benefit that I wanted to point out that's here that you wouldn't have on the term is the lifetime income. Let's list it down here, lifetime income. So this does have lifetime income that if you get the plan at least for 10 years and are 60 years or older, you can turn on lifetime income and turn this policy into a pension for you. And so going back up, looking at, again, the unique feature of it being a permanent plan is that when we look at this, and I did this one assuming the person paid the $300 for 20 years, and after 20 years, they were done. So they paid 20 years, they would pay $73,000 or $72,000 for it over 25 years, and they have cash value that they can pull out of the policy of $122,000. So in essence, if they decided they wanted to cash it in, walk away, they walk away with $122,000. or they can take this out as a loan. Same thing at this 30-year mark. 30-year mark, again, we stop payments at 20 years. They paid a total of $72,000. Their cash value at that point is $158,000. And when we look at this really in some comparison of the long-term benefits, if we look at that term policy, what was it at 30 years? At 30 years, they paid in $73,000, but they have zero cash value. And they're still paying, right? They can't stop paying the term because it's like renting. If you stop, the coverage stops. And so that's one of the major differences between the two. But again, you know, I remind you, there's nothing wrong with starting with term if that's where you need to start. And you can convert all of it or part of it over time. And so then this just shows us continuing on without even making any more payments. Now at 84, there's, you know, over 286,000. The other thing is, by it being an index, what's happening is that there's a zero floor when it comes to your cash value. So if the market goes down, then you're not going to experience your cash value going down. If the market goes up, it's going to go up. And so we're using these indexes in order to do that. In this particular one, I'm using this US pace setter, and the numbers that I'm showing you are all based on 6.42%. But as we can see, the 5-year average, the 10-year average, 15-year average have been much higher than that. But legally, all we can show you is 6.42. So we fully expect that over the long range that it will outperform that 6.42. There could be times when, you know, like we've been in a very volatile situation with the market over the last 2 or 3 years, that you may not make any money, but you won't lose any. And then certainly we feel like that will be made up over time. And there's no cap to how much you can earn. So just wanted to share a little bit about that. And let me again pause and see if there are questions. I saw one question. I'll kind of answer this for everyone. I wanted to know, where can you find more information about the Kaizen? And you can simply go to www.Tony Jackson Kaizen, KAIZEN.com. And I'm more than happy to answer any questions that you have on the Kaizen or anything that we've talked about. You know, the first thing I'll tell you about the Kaizen is that the Kaizen is a, you know, there's certain income limits. The income limit is 100,000. In order to do that, and I think the cutoff age is 65. And you just have to look at, you know, how that works. Dylan says, can you convert a term into an IUL? Absolutely. We do that all the time. And Dylan, one of the things that sometimes people do is they want a large term policy, and it makes sense, right? So maybe you want $1 million term policy. You may not want to convert all that over into an IUL. And so a lot of times what we do is we might convert 100,000 of it over in 1 year, and then another 100,000 the next year. And we can just do that over time to get it all into that permanent insurance, such as the IUL. And then we let the rest of the term continue to run out through the whole term. But then we have that permanent amount of insurance that's going to be locked in, that when the term is over, I still have this coverage, and it's gaining cash value and all the other stuff we talked about. All right. Who else? Well, one of the things that I do want to encourage everyone to do is, if someone on my team or something invited you tonight, I encourage you to get with the person who invited you, and just, you know, talk about getting a free review. And I'm also going to offer that here. If I was the one who invited you, I am putting my link to my calendar in the chat. TonyJacksonAppointment.com. Make an appointment with me. Let's have a review. Even if you're a current customer and you have policy, let's review that. And then the other thing, as I was mentioning, the book. Anyone who does schedule an appointment with tonight, I will give you a free copy of the book. When we have our appointment, just remind me, make sure you get me your address, and I'll get you a copy of the book at no charge at all. So, anyone? Y'all so quiet tonight.
I have a question.
Yes, ma'am.
So you know how like individuals are to pay their premiums annual. Do people ever pay premiums like more than 1 year premiums? Like, like you get extra money during income tax if you want to pay like 3 years worth of premiums. Can people do that?
Absolutely. Absolutely. So what happens is we set up a premium, it's like a premium account that's attached to your policy. Because one of the things that can happen is that if you put too much money in your life policy too quickly, you lose your tax benefits. It becomes what we call a MEC, modified endowment contract. So you lose your tax benefits. So what they do is they create a separate premium account where your money sits in that premium account earning interest. And then when it comes due, they'll put the money in there. So it could just move right from your premium account into pay for your premium. So that's how that would work. And some people pay, I mean, there's people that may say, well, I want to pay, 10 years worth. I mean, I have a big lump sum. I want to pay it up now. I don't want to have to pay. And so what we do in those situations is we can figure out, we'll discount it according to the interest rate that account is going to get. And that's, enough to cover, the policy until it's paid up. So it's there. So you can do that. Absolutely. That's a great question. Anyone else? Any other thoughts about borrowing from the policy or any of the things, Kaizen, that we've talked about? All right. If no one has anything else, I won't continue to hold you. Maybe y'all watch, is it a football game on? Maybe y'all watching the game. Maybe they're watching the game tonight, right? I don't know. Multitasking. That's what we call it, right? I hear you, Dylan.
How are you?
What's that?
Hello, Tony. How are
Hey,
you?
Patricia, how you doing?
Sleepy.com.
Sleepy.com.
That's why you ain't heard me say too much.
I know you've been quiet tonight. I have two people here that I usually count on that they will have a couple questions or two, and both of y'all have been quiet. So go ahead.
No, I'm on Eastern time.
Yeah, I know it's late for us, right? So, all right. Well, I certainly appreciate
great presentation.
Thank you. I appreciate you all being here tonight. And so please make sure that, once again, that you reach out and let's connect and have a conversation. Let's see. When am I going to do this presentation again? I hadn't planned. Next month, we're going to do something a little different. Next month, I'm going to be talking about creating lifetime income. And so, we're going to be talking about creating lifetime income. And so I might come back again, maybe in November, and do this particular one again. I did record it tonight, so we will send out the recording to everyone who's registered. I will send the recording out. Now, there was another question that came up is when I talked about that premium account where you paid excess premium. And one of the nice things about doing that versus putting it all in the policy too, is that if death occurs while you have money in that premium account, that money that hasn't been paid into the policy will also go to your beneficiary. So that excess premium that you paid would go to your beneficiaries. So, and I'm just curious before we get off here, where's everyone located? Normally we do that. Put in the chat where you're located. I'm just kind of interested to see geographically where we all are. All right, we got Greenville, Atlanta, DC, Florida. A couple of those I knew. We got Connecticut, Nashville, Maryland. We got a pretty good spread of people. Charlotte, I know my Charlotte people. I know we got Mississippi in the house as well. Durham is here. So pretty awesome. Thank you all for joining. I'm not going to hold you. Please reach out to me if you have any questions. When I send the email out, I'll have those links as well to schedule and all that good stuff. Sound good? All right, everyone, have a wonderful evening. Thank you.
Good night.
Good night.
All right, good night, everybody.
Bye-bye.
Good night.
Thank you.
Thank you.